This week, the Hang Seng Index in Hong Kong fell below 16,000 points. The last time it was at this level was during the stock market crash of the 2008 financial crisis, but this time it's even more devastating. The Hong Kong Growth Enterprise Market Index has been plummeting from its peak of over 18,000 points to its current 26 points, almost approaching zero. Entering 2024, the Hong Kong stock market seems to be in a downward spiral for over 90% of the time. On January 22nd, the Hong Kong stock market continued its 3-week decline, falling to nearly its lowest point in 15 months, breaking the psychological support level of 15,000 points. Mainland Chinese stocks in the Hong Kong market have also worsened, reaching their worst situation in 15 years. While the Hong Kong stock market is facing a downturn, other Asian stock markets are flourishing. 1. India. The Indian stock market has been soaring. As of the close on January 22nd, the total market value of stocks listed on the Indian Stock Exchange was $4.33 trillion, surpassing the $4.29 trillion of stocks listed on the Hong Kong Stock Exchange. India has become the world's 4th largest stock market for the first time. 2. Japan. The Japanese stock market started the year 2024 with strong momentum. On January 11th, the Nikkei 225 index opened high, rising 608 points in a single day, closing at over 35,000 points, breaking 34,000 points for the first time since March 12, 1990. 3. Singapore. In early January 2024, the Global Financial Centers Index ranked Singapore as the world's 3rd largest financial center, surpassing Hong Kong. Hong Kong netizens lament. Why? Why is the stock market in other countries rising while Hong Kong is falling? Why hasn't the dream of the Hang Seng Index reaching 40,000 points come true? Does God hate me? The Dow Jones Industrial Average was nearly 26,000 on February 1, 2019, and by January 19, 2024, it had risen to over 37,000. The Taiwan Weighted Index was just over 10,000 on February 1, 2019, and by January 22, 2024, it had risen to over 17,000. The Hang Seng Index in Hong Kong, by comparison, was at over 28,000 on February 1, 2019, but by January 22, 2024, it had fallen to almost 15,000. So it is not without reason that Hong Kong has become a relic as the world financial center.
The New York Times states the shocking reality. After being returned to China, Hong Kong has transformed from an international financial center into ruins. Shanghai has lost its luster, and now dust has settled on Hong Kong. If both Shanghai and Hong Kong, these two shining pearls, go dim, who can drive China's economy?
Many experts believe that the reason for the continuous decline of the Hong Kong stock market is due to the massive anti-extradition protests in Hong Kong in 2019. Beijing implemented the national security law in Hong Kong forcefully, not only suffocating freedom of speech, press, and civil society in Hong Kong, but also forcing over 100,000 Hong Kongers to flee, including many elites from the financial sector. This exodus of talent continues to this day. Many young people and professionals who are still in Hong Kong aspire to leave, making it increasingly difficult for Hong Kong to attract the talent it needs to operate as a financial center. Furthermore, the current Hong Kong government is either forced or willingly pro-Beijing. This has led to a significant outflow of foreign capital from Hong Kong.
In the past century, Hong Kong was the pearl of the Orient, the gateway for funds entering China from all over the world. They had to go through Hong Kong first. Now, due to Chinese governance, it's just a city in China. If Hong Kong's current international status disappears, Hong Kong will no longer exist.
Although officials like John Lee Ka-chiu, the executive of Hong Kong, are trying hard to sing the praises of Hong Kong and maintain a self-deceptive optimistic spirit, foreign companies have decided to vote with their feet. According to data from the Hong Kong Census and Statistics Department released December 2023, only about 1,300 foreign companies used Hong Kong as their regional headquarters last year, compared to over 1,500 in 2019. In other words, in just 4 years, over 200 foreign companies have left. Headquartered in California, TTM Technologies, a printed circuit board manufacturer, is one of those foreign companies that have decided to leave Hong Kong. Additionally, Canada's Alberta Investment Management Corp., the U.S. tech company Vantage Data Centers, and the government of the Cayman Islands all considered setting up regional headquarters in Hong Kong, but ultimately chose Singapore. While a significant amount of foreign capital is leaving Hong Kong, Chinese companies are deliberately moving in. The Eurasia Times reports that the number of Chinese companies in Hong Kong has more than doubled, and for the first time in 30 years, the number of Chinese companies with regional headquarters in Hong Kong has surpassed American companies. With so many powerhouse companies from China, shouldn't foreigners be fleeing this situation? Perhaps these foreign companies are following Sun Tzu's advice in The Art of War. After all, in military strategy, the best strategy is to retreat. As Beijing's control over Hong Kong deepens, shaking the city's status as an Asian financial center, Alex K.Y. Wong, a partner at a wealth management company, says that market sentiment is worse than in 2008. There's an old Chinese saying, "When blessings come, misfortunes follow." This saying seems most fitting for Hong Kong now. On December 6, 2023, credit rating agency Moody's downgraded Hong Kong's outlook from stable to negative. As we enter 2024, concerns about Hong Kong have only grown. On January 2nd, after India's stock market caught up with and surpassed Hong Kong, Bank of America announced a layoff of approximately 20 bankers in Asia, with Hong Kong and China being the hardest hit regions. However, it's amusing that, in the face of Hong Kong's various challenges, the Hong Kong government and some patriotic financial scholars continue to deceive themselves and occasionally release laughable wisdom. For instance, Hong Kong's patriotic financial host Cai Kang-nung wrote a post in January suggesting a hidden connection between the Hang Seng Index's performance and the Jimmy Lai case. He claimed that whenever the Jimmy Lai case had a hearing, the Hang Seng Index would drop. The Jimmy Lai case involves charges against prominent Hong Kong pro-democracy activist and media mogul Jimmy Lai, including unlawful assembly during the 2019 protests, collusion with foreign forces under the national security law, and fraud-related charges, symbolizing the Chinese government's crackdown on dissenting voices and the erosion of civil liberties in Hong Kong. Cai Kang-nung stated, "As of January 21st, there have been a total of 13 hearing days in the Jimmy Lai case. In the first week of hearings, which started on December 18th, the Hang Seng Index fell by a total of 452 points. During the week of December 27 to 29, when there were no hearings, the index rose by 707 points. Then on January 2nd, in the second week of hearings, the index dropped by 512 points. On January 8th, in the third week of hearings, it fell by 936 points. The Post questioned whether all of this was just a coincidence and mentioned that there are expected to be 80 more hearing days in the case. Some Hong Kong netizens expressed that Cai Kang-nung, as a staunch believer in rule by law, is clearly trying to blame Jimmy Lai for the Hang Seng Index's significant decline, insinuating that this is the result of foreign forces manipulating behind the scenes. Other netizens commented humorously, "Isn't it interesting? If Mr. Lai has such great power to make the Hang Seng Index plummet, then conversely, if Jimmy Lai were released, would the Hang Seng Index rise to 40,000 points? If all Democratic figures were released, perhaps it will reach 60,000 points." Certainly, the Chinese Communist Party and the Hong Kong authorities are unlikely to release Mr. Lai. How to rescue the market? The CCP is once again deploying the national team. Reuters has reported that after the Hang Seng Index breached the 15,000 point mark, China is considering a series of measures to stabilize the plummeting stock market. Bloomberg reported on January 23rd that Chinese officials are studying the use of 2 trillion Hong Kong dollars to purchase mainland A shares through the Hong Kong Stock Exchange to support the market. After the news broke, both the Hong Kong and mainland stock markets rebounded. However, some astute Hong Kong investors have expressed skepticism, suggesting that if the CCP really had 2 trillion Hong Kong dollars, it would probably be used to rescue failed real estate giants Evergrande and Country Garden instead. In fact, Bloomberg's report pointed out that Chinese officials are still weighing other options and emphasized that these plans could still change. Market experts analyze that even if the CCP does inject funds to rescue the market, the policies are likely to have only short-term effectiveness. Zhu Chengzhi, president of Marbo Asset Management Group, said, "If you try to stabilize it by simply injecting money, it may have short-term effects, but it may be difficult in the medium to long term. The most severe problem on the mainland is the real estate issue, not the stock market. The ongoing downturn in the real estate market will affect GDP performance significantly and lead to changes in various aspects of private consumption power, which is difficult to resolve. In recent years, Hong Kong has lost its democratic freedoms, witnessed a sluggish stock market, declining property prices, and economic woes, leading to widespread discontent among its citizens. Unfortunately, the people of Hong Kong can now only find solace in the resilience amid adversity. If you look at it from the other side, do you think the Hang Seng Index is thriving? That's just because you are pessimistic. What I see is that the more the Hang Seng Index falls, the smaller the room for further falls. Actually, Hong Kong used to be the goose that could lay golden eggs, but it has now been killed by the Chinese Communist Party. The British Empire spent over a century building Hong Kong from its original small fishing village into one of the world's 3 major financial centers. However, the CCP managed to turn Hong Kong into a financial center relic in just a few short years. The destructive power demonstrated by the CCP is likely unparalleled on a global scale. So is there still hope for Hong Kong? Perhaps only the heavens know the answer. However, it's important to note that Hong Kong's fate depends not only on political and economic factors, but also on the support and attention of the international community. The people of Hong Kong have been fighting for their rights and freedoms, and the international community has been monitoring the situation in Hong Kong. The future will depend on the efforts and determination of all parties involved, but hope always remains.